Tesla is one of the hardest companies to value on the market right now because of how multifaceted it is and because of its potential to be a lot more than just an electric vehicle company. Since it became profitable in 2020, the stock shot up 1,300% and is still up almost 800% since then. It has run 130% this year to date in 2023 since the end of September. However, it's still down 40% from its all-time high, and it dropped over 70% back in 2022. Nevertheless, it remains the most valuable automaker by market cap in the world. The company has achieved this by creating enormous advantages over its competition. For example, it's the current leader in the electric vehicle market by far in terms of volume and margins, and that's even including their recent cost-cutting strategy. It has a monopoly of the electric charging stations of vehicles around the world, for which it's now getting into vehicle partnerships with other car brands like GM or Ford. They're constantly working on full self-driving and will likely be the first mainstream car maker to bring mainstream full self-driving to the market. Analysts are just now starting to also understand the implications of Dojo. Tesla has growing energy solutions and batteries, and the brand itself is an incredible asset because whether you like him or not, Elon Musk is one of the most important and influential people of our generation. He has access to a crazy plethora of companies like X, SpaceX, Starlink, Neuralink, and the Boring Company that he can all potentially use one day to complement Tesla. Is Tesla a stock to buy for the long term? Will the stock recover and reach new highs? What are the challenges it faces in the current market? What might the company look like in the future? To try and answer these questions, we'll break out answers in the following segments: business, fundamental analysis, buy and sell activity, risks, and Tesla in the future. Number 1, business. At the moment, Tesla is primarily a car company with two main business segments: automotive and energy generation and storage. As of its latest earnings, 95% of its revenue comes from the automotive segment, while only 5% from the energy segment. The automotive segment designs, develops, manufactures, sells, and leases high-performance, fully electric vehicles. The main products for the automotive segment are the 4 consumer vehicles: the Model 3, the Model Y, the Model S, and the Model X. This also includes things like paid supercharging and vehicle insurance revenue. The Tesla Model Y is their best-selling model in the world and currently goes for $47,740. For energy generation, the products are the Powerwall and the Megapack, which are lithium-ion battery energy storage products. The Tesla Powerwall is a solar battery that costs between $9,200 and $14,200. They also have solar energy offerings like the retrofit solar energy systems and the solar roof. Both the automotive and the energy segment have been seeing some strong growth year over year. The automotive segment grew 52% and the energy segment 40% against 2021. We'll take a better look at the sales growth numbers in the fundamental analysis section, so make sure you watch until the end if you want to see that. In terms of markets, Tesla sells in the US, China, and Europe, and wherever they have charging stations. They have 4 manufacturing locations in the US and 1 in China and 1 in Germany. The United States is Tesla's primary vehicle market, where they control 50.58% of the total electric vehicle market share. During the first half of 2023, they reported a 57% year-over-year increase across all regions for sales. Although the USA and China are the largest markets for Tesla, Europe is growing fast and showed 119% year-over-year growth in 2023. Competitive advantages. Tesla has a lot of competitive advantages, which is why it's doing so well compared to its competition. And that's aside from being the first comer in the electric vehicle industry. Number 1, technology. Tesla has a very modern approach to developing cars like it would a software. It's almost half a car company, half a technology company because it issues software updates to update its cars every couple of weeks. AI is a huge part of that, as they're developing things like full self-driving and Dojo, and even humanoid-looking robots to improve their manufacturing process. Tesla's manufacturing aim is to implement automation to the fullest. Their automation in their current factories is approximately 10 years ahead of the competition, which helps drive costs down and volumes of production up. Simplified buying processes. They simplified the car buying process. You go online, you pick a model, add your features, place your deposit, and schedule a pickup. They don't use a typical car dealership type model, which improves the customer buying experience. Battery supply chain and energy. Tesla currently produces more batteries in terms of kilowatts per hour than every other car maker combined. Their cost of battery cells continue to decrease through economies of scales and innovative manufacturing. Their position in energy is greater than just batteries though. For example, the Tesla Powerwall 2 is one of the most advanced energy storage systems in the world. Tesla's supercharger network. Their super fast charging stations are all over the world. They own 58% of the network in the US, and it doesn't seem like anyone's even trying to compete. For example, they recently made an agreement with GM and Ford to grant their electric vehicle owners access to Tesla superchargers. And eventually, they'll integrate Tesla superchargers tech into GM and Ford vehicles. Fundamental and technical analysis. Fundamentals. Looking at Tesla's historical performance, we can see that they struggled with losses in the past. But starting in 2020, they became profitable and the stock surged like crazy. Since then, they've been growing fast, but their margins have started to take a hit in recent quarters. For example, in their latest quarter, Q2 of 2023, their profits grew 20% and their revenues 47%, outperforming Wall Street's estimates, which is a sign of strong and healthy growth. They've continued to show a record number of vehicle deliveries, even though the growth has slowed in recent quarters. This is compelling considering the macroeconomic conditions and rising interest rates environment. They managed to drive more vehicle sales by making price cuts of up to 20% on all their vehicles across the world, which sparked more demand and also pushed down competitors that are struggling with margin. The Model 3 also recently just qualified for the $7,500 electric vehicle federal tax credit, which helped them drive more delivery numbers. Although it's not exactly clear what triggered this change, a director at Morgan Stanley said that it was likely due to changes in the supply chain to produce batteries in the US and regulatory semantics. For these and other reasons, Tesla's total gross margins fell 5% versus Q1 of 2023 from 19.3% to 18.2%. But that's notable because they make price cuts of up to 20%. That being said, margins came in below the 20% gross margin floor that Tesla had promised, which caused a little bit of panic among analysts. Elon Musk reassured them though, saying that these are all short-term variances and that will all look silly as they scale their autonomy. And he's probably right, because compared to its competitors, Tesla is still miles ahead. According to this, in Q3 of 2022, their profit margins were still 4 times better than the next best competitor. In fact, looking at the financials compared to the competitors, Tesla is mostly leading on every front. A caveat is that BYD is not included in this analysis because it's an ADR and so the data didn't fit in this format. It's definitely one of the stronger competitors and is close to Tesla in terms of performance. In fact, it even sells more total vehicles than Tesla does. That being said, a lot of its vehicles are hybrid, so it's not exactly comparable to Tesla. Regardless, in terms of fundamentals compared to the competition, Tesla is destroying the competition on all fronts when it comes to margins and growth. You can look here, Tesla has 2 times better net profit margins. They have no debt, that's 23 times better than the next best competitor. Their return on assets is 4 times better than the next best. Their return on investments is 4 times better than the next best. Their sales per employee is actually lower, but that's probably because they're pushing a lot of non-scalable things that they will eventually automate. Their sales growth over the last 5 years was 50 times better than the next best. Their earnings per share forecast for the next 3 to 5 years is 2 times better than the next best. So clearly, when it comes to health and financial statistics, Tesla has a huge edge over the competition. But a large reason for that is because all of these competitors are large, mature companies that sell a lot more cars than electric vehicles, and they've all seen diminishing returns. The main problem with Tesla statistics is when you compare the stock price to the growth. Per share metrics look a lot weaker for Tesla because the stock price has risen so much. For example, their cash flow and cash flow per share is a lot lower than most competitors. They have a pretty high PE ratio, which makes conservative investors think that it's overpriced. Nonetheless, overall, their fundamentals look strong compared to the competitors. The company's finances are well managed, and hopefully that will still continue even though the CFO just left. Technical analysis. The stock is down 40% from its all-time highs, which is never a good thing. But we can see it has recovered a lot this year since its over 70% decline. At a glance, you can see that Tesla is definitely not a stock for people with low risk tolerance. It has gone up and down in value a lot throughout the years. So far in 2023, it's gone up an outstanding 133% this year to date and appears to be in a pretty clear uptrend. In the long term, we can see that this latest price pattern is kind of high flag type pattern that rockets and then consolidates. In the short term, relative to its own price, you can see that it's actually trading pretty fairly using this Fibonacci extension. However, at the moment, it looks like it's below its moving averages, which could indicate some more downside ahead. That could also be supported by their Q3 earnings coming up on 10/18, which have mixed expectation for vehicle sales. In the longer term though, it wouldn't surprise me that Tesla keeps on rallying and moving forward, seeing how strong their fundamental growth is, as well as their projects in the pipeline, which we'll talk about at the end of the video. Overall, it doesn't look too bad, but here's why I don't feel that strongly about jumping in just right now. Anything below their previous high is a very early entry. Another big concern is that they had rocketing earnings for the last couple of years because they were basically starting from zero. They also got boosted from COVID trading, which set the price target extremely high. But now growth is starting to slow, and so maybe reality is taking its place, and it's creating the questions of whether Tesla will ever be able to match its previous growth that it had, or how long that will take. I don't doubt that they will be able to find ways to sustain growth longer and stronger than most companies have up until now. When is that going to happen? But we're not exactly seeing that trend just yet. It also happens that a stock rockets because it's the new industry trend and it capitalizes on the bubble cycle. But then it never reaches that high again. A classic example of this is Cisco. Around the year 2000s, it rocketed thousands of percents, but then it dropped 80% from its peak. And you can see here, even though it rocketed back 130%, it was basically flat over the next 14 years. And 23 years later, it still hasn't reached its previous all-time high and is down almost 30% from its peak. Buy and sell activity. Tesla has high insider ownership at 13%, and Elon Musk controls most of that even after selling a lot of his shares to buy X. There has been some scrutiny over him selling his shares because he basically dumped a massive amount, pushing a stock that was already falling down even more. Kimball Musk is also a director, which is Elon Musk's younger brother, so the Musk brothers have a pretty strong control over what their company is doing at all times. Over the last 6 months, insiders sold 50 million, which is reasonable, but not a sign that insiders are accumulating Tesla stock. In terms of analyst ratings, the majority of the recent ones are neutral positive. The sell ratings have increased in the last months, but not as much as the buy and hold ratings. The analysts at Morningstar gave it a narrow moat rating due to its intangible assets and cost advantage. When they made the report in April 2023, the stock price was $160 and they gave it a fair value estimate of $215. Since they issued the rating, the stock has exceeded their expectations. The biggest concern for Morningstar was the growth of the electric vehicle industry and competition that could weaken Tesla's lead on the market. Their price target is a little outdated now, but that's the deal with Tesla. It's moving all over the place, which makes it really hard for institutions to track. CFRA has a 12-month price target of 325. That would be a 27% upside to where the price is now. CFRA is excited by Tesla ramping up the new factories in Germany and Texas and the final release of the Cybertruck. Argus recently raised their price from 222 to 333 on the basis that electric vehicle sales will continue to outpace the overall growth of auto sales. They also see the supercharger playing a more important role in the future. Both Argus and CFRA mentioned that Tesla will likely benefit from the $7,500 federal tax credit for electric vehicles. Institutions were buying up Tesla in Q2 of 2023, which is a positive sign. The number of institutions holding large stakes in Tesla went up as well. It looks like large asset managers like BlackRock and State Street were driving that institutional growth. On the other hand, some of the long-term holders like Cathie Wood or D. Shaw were net sellers in Q2. The accumulation of institutions overall is definitely more of a positive sign for Tesla than the opposite. It's becoming harder for them to ignore the disruption that Tesla has had on the automotive industry. Risks. Some people think that the electric vehicle industry is tiny and will never grow big enough. However, at the rate at which it's growing, electric vehicles are expected to account for 40% of the global auto sales by 2030. That's just 7 years from now. However, some people say that electric vehicle adoption is assisted too much by government initiatives such as regulation and subsidies, which could limit the long-term market growth for Tesla. There's also significant uncertainty for Tesla and the broader automotive industry, given the rapid advancement of autonomous vehicle technologies that could transform how consumers use vehicles altogether. For Tesla, traditional automakers are investing heavily into electric vehicle development, which could result in Tesla losing market share and seeing deceleration in sales due to increasing competition. This goes along with the risk that Tesla could face weaker than expected sales growth, less than expected cost efficiencies, as well as regulatory risks. In general, Tesla makes a lot of large promises but has recently fallen slightly behind on fulfilling them just yet. The latest margin decline is a good example of this. The Cybertruck production has also taken forever to start. Elon Musk has been promising robotaxis for ages, but it doesn't seem like we're close to that at all yet. To be honest, I think that Elon Musk is super ambitious and he does believe what he says he can achieve when he says it. He just sets very aggressive timelines. Maybe it would work if everyone in the company was Elon Musk, but that's not the case right now. Tesla stock is still below its all-time high, and as long as it's below 25% from its all-time high, that's a big risk. That being said, there are a lot of super exciting things that Tesla is working on. They've promised the production of the Cybertruck that's coming soon, and the Semi as well, which would really expand their product offerings. Elon Musk has said that Tesla customers will be able to use Starlink's networks. It's just a matter of time. Tesla is ramping up its production and aims to deliver on the goals of growing annual volumes by 20 million by 2030, which would make it the world's largest auto manufacturer. They've also invested a lot into battery technology, which could continue to decrease its production costs in the future. They've also started to perfect their Optimus robots, which could essentially get rid of more humans that are used to build cars. Tesla's Dojo is the supercomputer that it uses to train its AI self-driving software. A report came out recently suggesting that Dojo could have larger implications to the automotive industry, where Tesla could sell its services to other car companies that would need to catch up to Tesla's self-driving tech. It could be similar to how Amazon Web Services became 70% of Amazon's total operating profit. The same thing could happen to Tesla's Dojo, and the potential market for that is huge. Full self-driving and robotaxis is a massive project for Tesla and could really determine the future of the company over the next 10 years. The Boring Company is building tunnels that can be used by Teslas. Way out in the future, Tesla's cars will probably be the first cars on Mars. It's in the realm of possibility to have Tesla connect through Neuralink at some point, where you could interface through the car through chips in your brain, although I'm not sure how useful that is if the driving is already automated. What do you think about Tesla? Is it the ultimate company that will take over the world over the next years? Like and follow for more. Let me know what company I should analyze next.